Obviously, there's been a lot of pain in the marketplace, and we're watching and keying in on the 2,800 level in the S&P cash index. That was an area of overhead resistance for a majority of the year, and then the last sprint, we took that out. It was ultimately becoming now a false breakout, and I think that investors have to be eyeing that number and be very careful if we just poke our head above it. In the financial sector, I think the XLF is a good proxy, and the 28 level in the ETF is also something to be mindful of.
I'm going to bring in Jim Lacamp, who's joining us on the phone, and I might just mention Quint as well. This is the voice of Wilfred, not of Morgan, who sounds
a little higher.
Sounds very different, but nonetheless, let's
Sorry
continue.
about that.
Not at all. Not at all. I sometimes let it fly when people say Will, but I think getting a Morgan needs a full correction. Jim, your view, because you're a little bit more optimistic about the outlook and whether or not we've topped or not.
Yeah, look, so there's a lot of headwinds out there, and I recognize that. The global markets have broken down. We've seen small caps break down. We've seen mid caps break down, and that's where in the NASDAQ there's been a lot of leadership there. And when you see leadership rolling over, it does bother you a little bit. But credit spreads are very much intact. The earnings season should be 23, 24%. The economy is growing without too much inflation yet. Yes, we are seeing some signs that inflation is coming. We don't have too much of it yet. And the 10-year yield has kind of outkicked its coverage here. We expect it to come back in, maybe get down to the 310 area, 3 to 310, in which case that's really accommodative for stocks. So you've got a situation where earnings are growing nicely. You've got credit lines intact, credit spreads intact, strong earnings. There's no reason to think that this economy is about to roll over. You look at leading and coincident indicators, they're turning up. We've never gone into a recession with these with leading and coincident indicators turning up. So no reason to think of a recession, and no reason to think that the forces of the tailwinds aren't still stronger than the forces of the headwinds. We could see more adjustment, but I think the market pretty much is doing a regular garden variety correction here.
And Quint, in terms of where investors should be positioning themselves in this market, especially given your investment thesis, I mean, the fact that we have seen the weakness we have in the big cap tech names that have been just outsized leaders for this market the last couple of years, are those buying opportunities, or should investors position themselves elsewhere right now?
Well, Wilfred, I will touch on that, of course. I think you have to be careful. It's easy to look at an individual tech stock that has been absolutely plummeted and just say, oh, now there's some value here. I think you have to see support. I'm not a fan of just buying and hoping and trying to catch a falling safe. I think we have to see, to our other guest's point, he makes great points, but we want to see good news bought. And we want to see follow through. JP Morgan, perfect example. A very decent quarter, stock trades up pre-market and then sells off considerably. Watch the character of the tape. If we see some good tech earnings and they are bought up and follow through, that might be your sign to start looking for some value in some areas that have been beaten up.